Welcome to the State and Local Tax Series for the Technology and Emerging Growth Space. I'm Bria Boylan, a tax manager in our State and Local Tax Group, and I lead sales and use tax within our Technology and Emerging Growth practice. I work with companies at every stage of growth, from seed stage startups to companies heading into a sale, to help them navigate sales and use tax and manage their obligations as they scale. I spend a lot of my time with SaaS companies, and this classification question is one of the most important and least appreciated risks they carry, because it doesn't depend on doing anything wrong. It depends on how the product is described and where the customer is, and both of those change over time. I'm here today with Danny to talk through this topic. Danny, thank you for joining.
Bria, thanks for having me. And welcome, everyone. I'm Danny Vacosa, tax partner in our core tax services group, working with tech and emerging growth companies. I work with a ton of startups in the income and sales tax space, and sales tax is definitely one of the biggest challenges we face. So, Bria, let's define the problem. When we say classification, what are the buckets we're actually talking about?
Yeah, thank you, Danny. For a software company, your revenue can potentially fall into several different state tax categories, and states draw the lines between them differently. The main ones are often software as a service, information services, data processing services, and pre-written or canned software. To a customer, a product might feel like one seamless thing. To a state tax authority, which bucket it lands in determines whether and how it's taxed. And critically, the same product can be classified differently from state to state.
So, the risk isn't that the company misreports, it's that the category itself is contested.
Right. And it shifts under your own feet. Here's the dynamic I want listeners to internalize. As a SaaS product matures, it tends to accumulate features that look less like pure software access and more like the delivery of information or data. You start as a tool that lets the customer do something, then you add analytics, then you add benchmarking against other customers' data, then you add data feeds, generated reports, maybe AI-driven insights. Every one of those additions is great for the product, and every one of them nudges you towards looking like an information service or a data service in the eyes of certain states.
And just that little nudge can flip the answer on taxability.
It can, and that's why it matters so much. The exact same revenue can be taxable under one classification and exempt under another. Whether the resemblance helps or hurts you depends entirely on the state. It generally cuts both ways. And that's exactly why you can't reason about it nationally. You can't say we're an information service or we're SaaS as if it's a single fact about your company. It's a state by state and sometimes city by city determination, and the same characterization is an asset in one place and a liability in another. Which brings us to the part that really amplifies all of this: home ruled localities.
Great. Can you define the home rule for listeners who think that sales tax is just a state level thing?
Yeah, of course. Most people picture a state setting the rules and the localities just riding along with the state's tax base. In home ruled jurisdictions, that's not how it works. A home ruled locality has independent authority to define its own tax base and impose its own tax, separate from the state. So a city or county can tax something the state doesn't tax at all, with its own rules, its own registration, and its own rate. For software companies, that means you can owe tax to a city even in a state that has decided not to tax SaaS. The locality marches to its own drum.
Chicago is a headline example here, and the mechanics are worth spelling out.
Yeah, Chicago is one every SaaS, digital, or data information company needs to understand. Illinois, the state, does not generally tax many of these services. If you only looked at the state, you conclude that your product isn't taxable in Illinois. But the city of Chicago imposes its personal property lease transaction tax, which applies to non-possessory computer leases and often encompasses cloud and SaaS services. So you have a state that doesn't tax these services sitting underneath a city that very much does. That gap is exactly the kind of thing companies miss when they first think of state first.
And the rate's been climbing, right? Which is why we're getting even more attention.
Yeah, this is the part I really want to flag because the trajectory tells the story. The rate on these non-possessory computer leases was 9% as of January 1st, 2021. It went up to 11 as of January 1st, 2025, and it is sitting at 15% as of January 1st, 2026. So in the span of 5 years, it goes from 9% to 15%. And it actually started even lower. The cloud rate was 5.25% back in 2016 and 7.25% in 2020 before it even hit 9%. So the real story is a tax that has nearly tripled in a decade. That's a steep climb for a tax that a lot of companies don't even realize applies to them. And it's based on the customer's location, not yours. Chicago sources its sales to where the customer accesses and uses.
Great. Wow, that's crazy. So let's walk through the Nexus registration mechanics because this operates independently of the state, yeah?
Yeah, Chicago adopted an economic nexus standard for the lease tax effective July 1st, 2021. So you actually don't need a physical presence in this city. If you have $100,000 or more of receipts from Chicago-based customers over the most recent 4 consecutive calendar quarters, that can create an obligation for a business. And because it's a home rule tax, registration is separate. You register with the City of Chicago Department of Finance. It is not handled through your Illinois state tax registration. So a company can be fully compliant at the Illinois state tax level and have zero idea it has a separate Chicago obligation with a separate registration, a separate filing, and a rate that is now 15.
And if the provider doesn't charge it, the obligation doesn't just vanish, which ties back to use tax.
Exactly. The lease tax is generally the customer's tax. The provider is supposed to collect it, but if the provider doesn't, the customer is obligated to self-assess and remit it directly to the city. So it behaves just like a use tax, an obligation that lands on the buyer when the seller doesn't collect. A Chicago business buying SaaS from a vendor who isn't charging the lease tax has a self-assessment obligation. And on the flip side, if you're the provider, there's a planning point here too. Chicago lets you apportion the tax to reflect users located outside the city, using the city's apportionment affidavit. So you're not over collecting on customers who aren't actually in the city of Chicago.
And Chicago is a marquee example, but it's not the only home rule story, right?
Yeah, it's not. Colorado is the other big one. Colorado has a number of home ruled, self collecting cities that administer their own sales tax separately from the state. Denver, for instance, taxes software and SaaS. You register and file with the city directly. And then Louisiana has its parish level system where local jurisdictions have historically administered tax independently. The common thread is that the local regime can diverge from the state regime. So you have to look below the state line. For a SaaS company selling nationally, that's a lot of independent jurisdictions making their own calls about what your product is.
All right. So let's talk about audit behavior because the premise here is that this is forward looking, not just a reiteration of rules. What are the auditors actually doing differently?
The thing that's changed and that companies need to absorb is that classification is now driven by how the product is described and documented, not by how the customer experiences it. Auditors have gotten much more sophisticated about reading the product. They're pulling your product descriptions, your contracts and order forms, your marketing language, your website, and even your release notes and change logs. They're building the classification case from your own words about your product.
So the marketing team can create a tax exposure without anyone in tax even knowing?
Yeah, and that's the uncomfortable truth. When marketing rewrites the website to lean into data, insights, intelligence, because that's what sells, they may be handing a Texas auditor the argument that you're an information or data processing service. And it's not only Texas. New Jersey generally doesn't tax SaaS, but it does tax information services. So that same drift towards sounding like an information service can take the otherwise non-taxable New Jersey revenue and turn it to fully taxable. When product ships a feature and the release notes describe it as delivering reports or data feeds, that's evidence. The classification is being written in language all over the company by people who have no idea it has a tax consequence. Auditors know that, and they read those sources precisely because they're candid.
And how the product is invoiced matters as well, right?
Enormously. How you describe a charge on the invoice, whether you bundle it or separately state components, the language in the contract about what the customer is paying for, all of that feeds to the classification. Two companies selling a substantially similar product can land in different tax categories purely because of how they wrote their contracts and invoices. So the documentation isn't just describing the tax position, it's largely creating it.
Which means the right posture is to monitor this continuously, not just get an answer once and then file it away.
That's the whole forward-looking point. A classification determination is a snapshot of a product that's going to keep changing. The roadmap is going to add analytics, data, and AI features, and each of these can move you across a line in some state. So the position can't be a memo you wrote 2 years ago. It has to be something you revisit as the product evolves and as jurisdictions like Chicago change their rates and rules. You monitor the product roadmap with the same seriousness you monitor your Nexus thresholds.
All right. So bring it home on the practical side. What does managing this well actually look like for a SaaS company?
Yeah, it's a few connected disciplines. First, do classification reviews that are tied to the product roadmap, not a one time study, but a reoccurring review that asks every time the product meaningfully changes. Whether that change moves your classification in any key state, you're getting ahead of the drift instead of discovering it in an audit 3 years later.
And aligning the language across the company, yeah?
Yes, getting deliberate about your contract and invoice language. Since the documentation largely drives the classification, you want tax to have a seat at the table when contracts are templated and when the product is described in customer facing materials. That doesn't mean letting tax write your marketing, but it does mean being intentional because careless language creates exposure and careful language can support a defensible position.
And this is on the home rule side specifically?
You handle the home rule jurisdictions head on. Consider registering where you have obligations, set up accrual for ones where vendors aren't charging you, like the Chicago lease tax self assessment we talked about, and monitor rate changes because Chicago alone went from 9% to 11% to 15% across these last few years.
Okay. And on the through line for all of it.
The through line is that this is going to be a partnership, not a one time answer. The product evolves, jurisdictions evolve, and rates evolve. The companies that handle this well treat classification as a living position that they will revisit as features ship and as states and cities change the rules. So they're never surprised by where their product has drifted. That ongoing monitoring is exactly the kind of work we do with our SaaS clients in the technology and emerging growth practice.
Okay, Bria, this is a lot of information to digest. Give us one sentence to leave listeners with on a classification risk.
Yeah, of course. Your product's tax classification isn't fixed. It moves as your features evolve and as state and home rule jurisdictions like Chicago change their rules and raise their rates. So treat it as a position you monitor, not a question you answered once.
And for companies that want help staying ahead of it,
It's the heart of what our state and local tax team does within the technology and emerging growth practice. We run reviews tied to your product roadmap, help align your contract and invoice language, get you registered in accruing and home rule jurisdictions, monitor rate changes like Chicago, and stay engaged as your product and rules keep changing. If any of this sounds familiar, reach out. We'd love to help you get ahead of it rather than behind it.
Bria, thank you. And thanks all for listening.